What's going on? Alex here, and today I'm answering your tax questions from Reddit. Now, today's question has to do with IRA-related tax issues. And this question comes from Midnight Miasma. Hopefully I'm pronouncing that correctly. All right, so it says, over the years, I have accumulated relatively modest Roth IRA, traditional IRA, and SEP IRA accounts. Until last week, the traditional IRA had $25,000 pre-tax and the SEP IRA had $16,000 pre-tax. On the advice of my CPA, I contributed $6,000 post-tax to the traditional IRA. She advised me that I could roll that amount over to a Roth. I had a sneaking suspicion that this was bad advice, so I dug around a bit and found the IRS Pro Rata Rule. I asked my CPA about it, and she said she wasn't well versed in retirement account taxation and that I'd need to look into it myself. Whoa. Okay. Let's look at the questions. Does the Pro Rata Rule apply here? If so, can I convert just a traditional IRA and pay tax on the $25,000 pre-tax, or do I have to somehow factor in the $16,000 in a separate SEP IRA? Number two, I'm in a reasonably high tax bracket and pretty young. I expect that I have enough to retire without necessarily touching the funds in these accounts, and that maybe I could pass it on to my kids. Is it crazy to consider doing a Roth conversion in this situation, even though I'm in a higher tax bracket right now? And three, am I out of line for thinking that my CPA should know these answers, or at the very least should not have recommended doing a backdoor Roth without knowing how it would affect my taxes? Great questions. So let's take a look at these aspects one by one. What are we talking about with the Pro Rata Rule? Let's take a look at an example just to get a 30,000-foot view of what's going on. So let's say a taxpayer has a traditional IRA account. And this is pre-tax. Okay. And a traditional IRA can have both pre-tax and post-tax amounts, but let's just assume that this particular account is composed of only pre-tax amounts. And let's call this traditional IRA number one. And then you have another one and another one, all separate accounts. And then you have a SEP IRA, again, pre-tax. And finally, you have, let's keep it at that. So let's say the balances are as follows. So you have, let's say, 20,000 here, 30,000 here, 40,000 here, and what does that give us? Let's take a look, and 10,000 here. All right, so for a total of $100,000. All right, so with that 100,000, let's say we wanted to start a new IRA account, but in this account, we contribute on a post-tax basis, which means we don't get the deduction when we make that contribution. We just put in, let's say, $6,000 without deducting it on the tax return. So it's a post-tax or non-deductible contribution, whatever you want to call it. Now, the issue arises when a taxpayer says, you know what? I'd really love to, oh, by the way, this would be account number 4. I'd really love to take this $6,000 and do a Roth IRA conversion. Or the taxpayer might say, hey, you know, I want to take that $6,000 as a distribution, and since I didn't deduct it, I don't want to have to pay taxes on it. Is there a problem there? Unfortunately, there is. The way the tax code is structured, the IRS does not want anybody cherry-picking the post-tax amounts to take as a distribution or to convert to a Roth IRA. So how this would work is as follows. So let's say you want to take a distribution from this account of the $6,000. So you have the $6,000 amount. Now the question is, how much is taxable? Right? Because you want to determine what's actually going to end up on your tax return. a common misconception is that you can take the $6,000 post-tax amount because you didn't deduct it up front and simply take the distribution, not have any income tax implications. That is not correct, unfortunately. And the way it works is as follows. So this $6,000 distribution is a certain percentage of the total IRA balances. So if we make some more room here, all right, we could see that the total IRA balances, quite simply, are $106,000. And the distribution percentage is as follows. Okay? So you could see that the amount of the total IRA balances that we're distributing here is 5.66%. So in other words, that post-tax amount, that post-tax IRA balance is 5.66% as a percentage of the total IRA balances. What does that mean? So when it comes to calculating the taxable portion, this percentage comes into play. So let's also calculate the non-taxable portion of the distribution and make sure you guys could see all this. So now, the total distribution is $6,000. And now we're going to see the pro rata rule in effect. So now, out of the $6,000, to figure out the non-taxable portion, it's not 100% because it's 5.66% of the overall IRA balances. So the non-taxable portion is actually $339.62, which means that the rest of the distribution, $5,660.38, is going to be taxable. All right, and you can see this gives us a total of $6,000, which is the total distribution amount. And this trips up taxpayers all the time because they're not aware of the pro rata rule, which basically means that if you have a bunch of IRA accounts and you have a post-tax balance, whether or not it's in a separate account, doesn't matter. It's the same rules apply. I just put it in a separate account here just to make it a bit clearer. But you need to consider the overall balances of the IRA accounts and compare that to the post-tax amounts. And really what this is saying is 5.66% of the IRA balances are post-tax, whereas the rest of the percentage, meaning 1 minus 5.66%, 94.34% is the pre-tax amount. So that is what is going to trigger the taxability of the majority of this distribution. So you could see a taxpayer that was expecting just to take out the $6,000 of post-tax contributions is going to be sorely disappointed because whereas they expected to maybe pay no taxes on it, they're going to pay taxes on $5,660.38 of that distribution. So to be very clear, these aren't the tax amounts you're going to pay. This is the amount that you're going to include in income. That taxable portion of the distribution is going to be included in income, and it's going to be taxed at your marginal tax brackets at the federal and state levels. So, and if this is an early distribution, meaning that you're below age 59 and a half, there may be some additional penalties that are involved as well in some cases if you're taking a distribution. So another thing to keep in mind. But this is the pro rata rule in effect. Now let's go back to our question. This individual had $25,000 in a traditional IRA, this is what TIRA stands for, and $25,000 and $16,000 in a SEP. So let's just create a separate example here. All right, so traditional IRA. All right, the balance there, $25,000. Rock and rolling, guys. So we also have a SEP IRA with a balance of $16,000. All right, so we go to the total, and this is the total IRA balances pre-tax, because again, this person specified that these are pre-tax amounts here and here. All right, so let's add that in. For clarity, guys, you know, we take the extra steps here. All right, so the total IRA balances of $41,000. So what this taxpayer then did at the advice of their CPA, we'll see if that's good advice or bad, contributed $6,000 post-tax to the traditional IRA. All right, so let's just look at it as a separate account, but at the end of the day, let's put it down here. At the end of the day, it doesn't matter if it's a separate account or not. The treatment is the same. So now we have $6,000 in a post-tax account. First question, you guys should already know this. What is the total amount of the IRA balances? Just like we had up here. So in this example, we had total pre-tax IRA balances. Let's just call this the same thing here. Then we have the additional post-tax amount. Total IRA balances is the next step. Just want to show you guys that we're doing the same calculation. So $47,000. Now, similar to what we did in this example, we have the distribution amount. And in this case, it's actually a Roth conversion. So let's take a look at that for a second, because the pro rata rule still applies. And we can see that it's the $6,000. Now, this is the vital calculation that we need to make. What is the taxable portion and the non-taxable portion of the distribution? But to get there, we need to do a bit of math. So total IRA balances. Okay. Let's just do this separately here. We're getting too fancy. All right. So we have the total IRA distribution amount. So we get the percentage of total IRA balance. And we calculate that by doing some division. And we can see that it's 12.77% of the overall IRA balances that we're doing the Roth IRA conversion with. So in other words, we can look at it this way. Total distribution amount, $6,000. Roth conversion amount, and we basically rinse and repeat. Let's clean this up here. All right, so what we have is, and this is probably a bit duplicative, we're going to leave it for now. Non-taxable portion, how do we calculate this? It's the $6,000 times the percentage of the total IRA balances, and then the percentage is that non-taxable portion, right? So out of this $47,000, $6,000 is that post-tax amount, and that's how we get the 12.77. And we simply multiply the total conversion amount by that 12.77, and we get 765.96 as the non-taxable portion of the conversion in this case. Similarly here. Okay. And the taxable portion of this conversion is 5234.04, which gives us the total conversion amount of $6,000. That is the pro rata rule in effect, all right? They don't want you to cherry pick the amount that you're taking as a distribution or a conversion, and that's how that rule essentially functions. If you want to learn more about the specific details, because there are a few ins and outs that you need to take into account, this stuff can get very complicated very quickly. There's an excellent article by Michael Kitces called The IRA Aggregation Rule and Pro Rata Taxation of After-Tax IRA Dollars. Amazing article. I'm going to put the link in the chat for you guys. All right. So check that out if you want to learn more about this, because it really is a well done article, very clear, talks about some of the different implications. It also touches on the one rollover per year rule right here, once per year IRA rollover rule, and the IRA aggregation rule. So there's more details on that. But definitely, if you want to get a really in-depth understanding of all this stuff, check out that article. I always give credit where it's due. It's a great article, so that's where the credit's going. Now, let's take a look at the questions again, make sure we address them. Does the pro rata rule apply here? Unfortunately, it does. Now, what's a workaround? How can we get around this pro rata rule? Now, one of the approaches that you may be able to take is if you have IRA balances, like in this first example, you may be able to roll some or all of them into a 401k. So what happens then? Then you have a smaller balance of pre-tax IRA amounts to deal with in contending with the pro rata rule. So that is something that may be doable if you have a 401k that accepts rollovers from other retirement accounts. Not all 401ks do, but it's a possibility, and it's one way to possibly reduce the effect of the pro rata rule in a perfectly legal manner by rolling in some of those pre-tax IRA amounts into a 401k, and then you'll have the post-tax amount being a larger portion of your overall IRA balances, which would decrease the taxable amount on a distribution or a conversion. So that's one way to approach it. Just something to think about. Now, if so, can I convert the traditional IRA and pay tax on the $25,000 pre-tax amount, or do I have to somehow factor in the $16,000 in the separate SEP IRA? So you can't cherry pick, right? So even if you had let's change these numbers to reflect this $25,000 just on the traditional IRA. The math will work out exactly the same way, because you still need to apply the percentage, and that's going to affect the amount that's subject to taxation when you are taking distributions. Now, pay tax on the $25,000 pre-tax, or do I have to somehow factor in the $16,000? So it would depend on the balance that's actually being converted. So if you are converting the $25,000, you still have to apply the pro rata rule and go from there. Now, I am in a reasonably high tax bracket and pretty young. I expect that I will have enough to retire without reasonably touching the funds in these accounts, and maybe I could pass it on to my kids. Is it crazy to consider doing a Roth conversion in this situation, even though I'm in a higher tax bracket right now? So generally, Roth IRA conversions are useful when you are in a low tax bracket now and you expect to be in a higher tax bracket later, generally in retirement. Then there's a lot of implications here that go into the consideration of what's most advantageous. But generally, if you're in a higher tax bracket, it may be advantageous to prioritize deductions, meaning you're making deductible contributions to retirement accounts as opposed to adding to the income that's being taxed at the higher tax brackets by doing things like conversions and non-deductible contributions. So depending on your priorities and your goals, you may want to take a look at that and see if it's advantageous to take deductions now and have those amounts taxed in the future, as opposed to making non-deductible contributions now and doing Roth IRA conversions to avoid taxes later on. So that's dependent on your situation and your goals, so it gets a little bit personal there, but just some considerations to take into account. Now, third question, am I out of line for thinking that my CPA should know these answers, or at very least should not have recommended doing a backdoor Roth without knowing how it would affect my taxes? I would agree with that assessment, because CPAs have what's known as a duty of competence, all right? It's not a preference of competence. It's not a recommendation of competence. We have a duty of competence, which means we have to know about what we're talking about before we provide any sort of feedback or advice to clients, because you wouldn't want a brain surgeon working on you that doesn't have too much brain experience. You know what I mean? So there's some serious issues there. I don't want to denigrate the work of my fellow CPA associates, but I can tell you that if they don't know about something, they shouldn't be advising on it, all right? And this is a perfect example of that. And it's interesting that you kind of had a sneaking suspicion that this was bad advice. You may need to look around for a different CPA, let's just put it that way, because you shouldn't have to find out about parameters of taxation by Googling it yourself. Your CPA should really be on top of it. Or if they're not on top of it, they should not be advising on it, okay? So either you know it and you advise on it, or you don't know it and you avoid it altogether. You can't have both. Hopefully that's helpful in terms of tying this all in and providing some in-depth analysis of what the Pro Rata Rule is all about. But really, the Pro Rata Rule says the following. If you have pre-tax IRA amounts and then you have some post-tax amounts, you can't cherry pick which amounts you take as a distribution, meaning you can't just choose the post-tax non-deductible contributions and take that and not be taxed at all. Doesn't work like that. Similarly, if you're doing a Roth IRA conversion, you still can't cherry pick and avoid the Pro Rata Rule, okay? It's applicable generally with distributions and Roth IRA conversions, and we looked at the mechanics of how that works. And obviously, there's other considerations to take into account. I'll tell you over and over again that retirement contributions and distributions get very complex very quickly. So if you have married versus individual, inherited IRA versus non-inherited IRA, it can get very tangled very quickly. So definitely, if you have specific questions about retirement plan contributions, distributions, and all of that, consult with a qualified tax professional before you make any decisions. Don't watch this video, run out, and make all sorts of decisions regarding your retirement accounts, because you may end up with some serious issues, meaning tax liabilities, penalties, and so forth. So definitely consult with a qualified tax professional before acting on any of this information. Hopefully that was helpful. I hope you had as much fun listening as I had fun talking about this stuff. I love taxes, even though it's almost 4 a.m. right now. So I got to stop this. That's it. The tea has run out. I'm going to run away. Hopefully this was helpful. Listen, if you got value out of this, feel free to subscribe to the channel. There's going to be a lot more content coming. Comment on the video, hit like, hit the bell icon, smash the subscribe button. I don't know what you people do, but do it. Hopefully this was helpful. Thanks for watching.